Hello, I'm David Hardesty. In this lecture, we explore the U.S. taxation of non-resident aliens and taxable foreign entities on business income earned in the United States. This lecture covers the taxation of this income under U.S. domestic tax law, without consideration of any tax treaties that may be available to the taxpayer. In a separate lecture, we cover the manner in which U.S. tax treaties affect the taxation of this income. The objectives of this lecture are to understand the following. The basic rule that business income must be effectively connected with the conduct of a U.S. trade or business before it is taxable to a non-resident alien or taxable foreign entity. What is and what is not a U.S. trade or business, and the income that may be effectively connected with that U.S. trade or business. Before moving to the substance of the rules, let's look at their applicability. First, the rules that we discuss here are equally applicable to non-resident alien individuals, foreign corporations, and other taxable foreign entities. The tax rules we will be discussing relate only to the taxability under U.S. domestic tax laws. The laws of the foreign taxpayer's country of residence do not enter into this discussion. In addition, rules we will be discussing do not address the taxability if a U.S. tax treaty applies. Here's the basic rule for the taxability of business income. Non-resident aliens, foreign corporations, and other taxable foreign entities are taxed in the United States on business income at graduated tax rates. The same rates apply to U.S. citizens and residents and domestic corporations on net taxable income, but only if the income is effectively connected with the conduct of a trade or business in the United States. Effectively connected income subject to regular tax rates includes interest, dividends, rents, royalties, and other FEDAP income that is effectively connected with a U.S. trade or business. Foreign taxpayers are taxed on the gross amount of this income when it is not effectively connected, as discussed in the lecture on taxation of non-business income. All other business income is excluded from the U.S. tax base. Thus, for example, regardless of the amount of business income that a foreign person garners from U.S. sources, that income is not taxable in the United States unless it falls within the scope of business income that is effectively connected with the conduct of a U.S. trade or business. A taxpayer that engages in a U.S. trade or business must file a U.S. tax return. The instructions to Form 1040-NR and 1120-F, the forms filed by non-resident aliens and foreign corporations, make clear that these taxpayers must file U.S. income tax returns when they are engaged in a U.S. trade or business. One practical reason for filing a return is if a tax return is not filed, then the taxpayer must pay U.S. tax on gross income without reduction for expenses. That is, to claim business deductions against gross income, a foreign taxpayer must file a true and accurate U.S. tax return. Let us briefly discuss tax treaties we will go into more detail in our lecture on the taxation of business income under tax treaties. In general, if a tax treaty applies, then a foreign taxpayer, non-resident alien, foreign corporation, or other foreign taxable entity can elect to pay tax in the United States only on income that is attributable to a permanent establishment in the United States. Income attributable to a permanent establishment may be less than the amount of effectively connected income. This concept is discussed in another lecture. Let's take a look at a simple example to examine the basic rules for the taxation of business income. Foreign Corp is a Country X company with offices and equipment in Country X, no physical presence in the United States, and no agents or representatives in the United States. The company makes $5 billion in sales of product X to U.S. customers. The resulting income is U.S. source business income. However, the company is not engaged in the conduct of a U.S. trade or business. Accordingly, the company does not have any income that can be effectively connected with the conduct of a U.S. trade or business and is not subject to tax in the United States on this income. This example is continued on the next slide. If we change the facts of this example so that Foreign Corp has an office in the United States from which some sales are made, then, as we will see later, all of its U.S. sales are deemed to be effectively connected with that business and are taxable in the United States. Foreign Corp must file a U.S. tax return in order to claim deductions against this income. The net income is taxed in the United States at regular graduated tax rates. Once again, these examples continued on the next slide. If Country X has a tax treaty with the United States, and if the U.S. office is a fixed place of business constituting a permanent establishment, then Foreign Corp can elect to pay U.S. tax on income attributable to that fixed place of business if that amount of income is less than its effectively connected income. Business income is taxed in the United States if it is effectively connected with the conduct of a U.S. trade or business. So let's take a look at the requirements for a U.S. trade or business. There's no general statutory or regulatory guidance to tell us whether a U.S. trade or business exists, and the IRS will not issue a ruling as to whether a U.S. trade or business exists. As discussed in a later slide, Section 864 provides guidance on the existence of a U.S. trade or business involving the performance of personal services, but that guidance is not helpful for determinations relating to other types of businesses. One way of approaching the question of the existence of a U.S. trade or business is to ask two key questions. Is the taxpayer engaged in a trade or business? And is that trade or business carried on in the United States? If both questions can be answered yes, then the taxpayer is engaged in a U.S. trade or business. The first question is whether there is a trade or business. This is another one of those questions that the IRS will not answer and for which there is little guidance in the code or regulations. Most of what we know about the existence of a trade or business comes to us from court cases. One of the most useful cases for identifying a trade or business is Commissioner v. Grotzinger. This case involved a full-time gambler who was judged to be engaged in a trade or business. This case gives us clear guidance as to the qualities an activity must have to be characterized as a trade or business. These qualities are as follows. First, the taxpayer must be involved in the activity with continuity and regularity. Second, the taxpayer's primary purpose for engaging in the activity must be for income or profit. Finally, whether a taxpayer is engaged in a trade or business is based on facts and circumstances. The second requirement for a U.S. trade or business is, if there is a trade or business, that activity must be carried on, at least partly, in the United States. Whether a trade or business takes place in the United States, that is, whether the business activities actually take place in the United States, is based on facts and circumstances. What guidance exists on the question of whether a business activity takes place in the United States comes to us from court cases and rulings discussed in the text, most of which are pretty old cases. As indicated by these cases, there's no easy way to determine if a foreign person is engaged in a U.S. trade or business. These cases include the Scottish American Investment Company, involving a Scottish investment company that was engaged in managing investments. The taxpayer was not engaged in a U.S. trade or business for reasons discussed in the next slide. Balanovsky, a foreign taxpayer whose U.S. activities included purchasing and exporting goods for sale outside the United States and purchasing and selling goods in the United States. Here, the taxpayer's U.S.-based activities were relatively substantial, and the taxpayer was engaged in a U.S. trade or business. Revenue Ruling 73-522, which involved a non-resident alien who owned U.S. real rental property. Here, the taxpayer was not engaged in a trade or business, much less a U.S. trade or business, because business activities were not regular and continuous. Here's the Scottish American investment case. In the Scottish American investment case, a U.S. office of an investment company maintained records of U.S. investments, collected dividends, sent reports to the home office outside the United States, voted proxies, and performed extensive clerical and routine services. However, all judgments as to the investments, the purchase and sale of securities, and substantially all other major policy decisions were made by officers in the home country. The court found that the U.S. office was not engaged in a trade or business and that the real business of the company took place outside of the United States. The U.S. activities were merely helpfully adjunct. What if a foreign taxpayer is not itself engaged in the conduct of a U.S. trade or business, but has an agent in the United States? A foreign taxpayer can be engaged in the conduct of a U.S. trade or business on its own account or through an agent. That is, a foreign company can be deemed to have a U.S. trade or business if it has agents in the United States. In general, the actions of an agent are imputed, that is, considered to be the same as the actions of a principal. Accordingly, any activity of a foreign person's agent in the United States is considered to be the activity in the United States of the foreign person. If a foreign person's agent engages in a U.S. trade or business on behalf of the foreign person, then the foreign person is deemed to be engaged in a U.S. trade or business. Whether a person engages in actions on behalf of a foreign person is a question of fact. A person merely providing services to a foreign person is not an agent. One action that usually makes a person an agent is making a contract on behalf of the foreign person, which binds the foreign person. Here's an example of actions and activities that make a person an agent. In the case Leeuwenhoek, a non-resident alien who owned several real estate rental properties in the United States was never physically present in the United States. However, he had an agent with broad powers to manage the taxpayer's U.S. property, including the power to buy, sell, lease, and mortgage real estate in the non-resident taxpayer's name. The actions of the agent in the United States caused the agent to be an agent for tax purposes and caused the foreign taxpayer to be engaged in the conduct of a U.S. trade or business. Here's another example. In Frank Hatfield, News Company sold cards on behalf of a foreign company, and News Company was deemed to be the agent of the foreign company. Key features of the arrangement that created agency were as follows. News Company did not obligate itself to buy any definite number of or amount of merchandise from the foreign company. Instead, it received merchandise, accounted for the merchandise it sold, and returned unsold merchandise to the foreign company. The foreign company paid for all shipping costs to and from the United States. The court found this to be a consignment arrangement where News Company was the sales agent for the foreign company. One of the few statutes on the existence of a U.S. trade or business involves the performance of personal services in the United States. Section 864 provides that the performance of personal services in the United States constitutes a trade or business in the United States. The provision is subject to an exception for de minimis amounts of services, as discussed in the next slide. The rule for personal services is subject to a minor exception that can prevent a taxpayer from becoming engaged in the conduct of a U.S. trade or business as a result of de minimis services. This exception provides that an individual is not engaged in a U.S. trade or business on account of personal services performed in the United States. The services are performed for a non-resident alien individual, foreign partnership, or foreign corporation not engaged in a U.S. trade or business, or the services are performed for the foreign office of a U.S. citizen or resident or domestic partnership or corporation, and the services are performed while the foreign person is temporarily present in the United States. The taxpayer is not present in the United States for more than 90 days during the taxable year, and the compensation does not exceed $3,000 for those services. As discussed in the lecture on the taxation of non-business income, personal services are not U.S. source if they meet a similar 90-day $3,000 exception Accordingly, minor personal services are not taxable in the United States. Note that the regulations provide that solely for the purposes of applying the Section 864B1 exception, the foreign employer is not considered to be engaged in a U.S. trade or business by reason of the services of the employee. Without this regulation, the exception would be nullified by its terms. It is important to know that this personal service exception applies to the individual, not the employer. What this means is, while the personal services exception may provide an individual with a minor exception to the taxation in the United States, it does not help the employer. The exception does not apply to the U.S. source income earned by the employer as a result of services provided by its employee or its agent. Accordingly, the minor services provided by an employee in the United States can cause the employer to be engaged in a U.S. trade or business. Here's an example of personal services creating a trade or business in the United States and the difficulties this can cause for a foreign taxpayer. Hernandez is an employee of Foreign Corp. S.A., a Country X corporation that provides software engineering services. Hernandez spends 120 days in the United States providing services to various Foreign Corp. Clients. Under Section 864, these personal services cause Hernandez to be engaged in a U.S. trade or business. This means he must pay U.S. tax on the income he earns. In addition, the income earned by Foreign Corp. As a result of services performed by Hernandez in the United States is likely to be trade or business income of Foreign Corp. Taxable in the United States. Now let us consider the impact of the personal services exception. In the previous example, Hernandez performed personal services in the United States on behalf of Foreign Corp. S.A., a Country X corporation. If the 90-day $3,000 exception applies to Hernandez, then Hernandez is not taxed in the United States on his compensation earned while performing services in the United States. This example is continued on the next slide. As to Foreign Corp., however, the 90-day $3,000 exception is not relevant in determining whether Foreign Corp. Is engaged in a U.S. trade or business. Moreover, Section 864B indicates that personal services create a trade or business. Thus, the services performed by Hernandez on behalf of Foreign Corp. May create a U.S. trade or business for Foreign Corp., despite the fact that the 90-day $3,000 exception applies to Hernandez. Another statute regarding the existence of a trade or business relates to securities trading. Under Section 864, when a foreign person's activities in the United States involve trading in securities or commodities, then there is no U.S. trade or business. The person trades through a resident agent, custodian, or independent agent, assuming the person has no U.S. office through which the trades are directed. Or the person trades for his own account, regardless of whether the person has a U.S. office that directs the trades or if the person has U.S. employees. However, this statutory exception to the existence of a U.S. trade or business does not apply to a dealer in stocks or securities. This lecture is continued in part 2, so please go there.